Hello and welcome to what will probably be the final and most certainly will be the shortest video in what has become a video series looking at correlation, basis, beta, and concluding now with implied volatility in pairs trades. I'm going to skip the Excel in this video, which is going to keep it much shorter. I'm not doing anything new here, so anything that you see can be done using the stuff that we've done in previous videos in Excel. Instead, I want to keep this really clean and really short, and I want to just wrap up what has been a much longer project than I originally thought. At the end of the last video, I sort of incoherently fumbled myself through a few questions that I had, mostly because I knew that there was sort of an end to this and we weren't there, but I wasn't quite sure how to get there. So once again, Tasty Trade has set me straight. TP sent an email back and said you got to put in IV, which should be obvious because it's Tasty Trade and we have to look at IV. So that's what we've done. So let's run through this. The top two parts we've done before. This part here is pretty simple. This is the 60-day beta measured in standard deviations to the mean in a pair. So it's simply the amount of price volatility now in comparison to the mean measured in standard deviations. We have today's beta for the Dow, for instance, measured to the S&P, everything to the S&P. So we have today's beta of the Dow at 0.926. We have the average beta is 0.889. So we're 0.86 standard deviations away from the average. So we're a little bit above, and we're exactly 0.86 standard deviations above. If we come down to the Qs and look, for instance, we'll see that today's beta to the SPYs is 1.61. The average is 1.27, so we're actually 1.77 standard deviations above the average beta. So we're looking at the average price volatility and how we compare today to price volatility over a long term. In this panel here, we really have the meat and potatoes and what ends up being the conclusion of all this work. This is the standard deviation distance from the average spread in IVs in today's spread. So one more time, we're looking at the spread of the IV and how that spread compares to the average spread over time as measured in standard deviations. So we are using the Russell and NASDAQ as an example, and you can see that today the spread of the IWM to the Q is 0.051. So the IV difference is 0.051. The average IV difference is 0.032. That gives us 2.4 standard deviations from the average spread in implied volatility between the Russell and the Qs. So we're way outside of the norm. If we come over to the IV index tab on my sheet, you'll see that I've got my hands on some IV data. Now, if you're going to try and recreate this and you're going to get your data through TOS, you're going to get IV rank. You're not going to get IV index or percentile. And if you don't know the difference, you haven't been watching the Skinny on Options math, and shame on you. But you can fix it by heading over to tastytrade.com and going to the archives, and then checking out 3.13.14 Skinny on Options math called The Difference Between IV Rank and IV Percentile, and that'll set you straight. If you're going to try and recreate this using historical volatility, you can't. It would be very easy if you could, but sadly you cannot. If you don't know the difference between implied and historical volatility, you got to head over to tastytrade.com one more time and check out my man Jacob in the Skinny on Options Math 5.30.13, the difference between implied versus historical volatility, and he will set you straight. I love that segment, by the way, Skinny on Options Math, so you should check it out. So here we have the a 4-option at the money weighted implied volatility index. Now, I can't swear to you that that is how Tasty Trade gets their data, or what formula they used exactly to get their percentile. So I can't swear to you that if you were to use their data that you would get exactly the same numbers as I have here, but I have a feeling that it would be very, very close. So let's look at what we've done. 60-day IV, and we're going to use 60 days because Everything we've done here is 60-day, and I'm just keeping it consistent for the sake of keeping everything easy and not getting into sort of the paralysis of analysis. So we have 60-day, and we're looking at the spread. So all I've done is I've subtracted the IV of the SPYs from the IV of the Russell right here. I've subtracted the IV of the Qs from the Russell here, and I've subtracted the IV of the spiders from the Qs here. And I've put them in line graph form, and you can see the average is the red line that runs across. And then I've thrown together some histograms just to see if we get a normal distribution out of these things, and in fact we do. So I was pretty happy to see that, but we would expect something like this out of IV, especially if you watched enough Tasty Trade videos. So how does this bring us to the conclusion of these videos? Well, if we come over here and we look at the IV of the Qs in blue, and we look at the IVs of the Russell in red, we can see points where the IVs compress and the IVs blow out, such as now. And we know through looking at these normal distributions that the spreads in IVs will tend to mean revert over time. These are indexes. They're not individual stocks. So there's not much of a chance that there would be some sort of fundamental change in the pairing that would completely blow apart the correlation and the IV spread between the two of them. So we're confident, or at least I'm confident, in trading the index products in this perspective. So from this perspective, so we have this spread as shown graphically here, and then if we remind ourselves back here, we can see it quantitatively in the number of standard deviations away from the average spread that we are. So where the conclusion comes in is basically by working our way through these four boxes. We have pairs of high correlation that are historically highly correlated and are highly correlated now. I'm using a 60-day basis. You can use whatever you want. Then we move over here and we have a basis, which is simply a ratio evaluation. So we're looking at the difference between the normal value, the valuation of one divided into the other. So we get some sort of a ratio and a relationship that is, quote, normal over time, an average relationship. And we can look at how stretched these valuations are over time, and this updates every day, which we did in the previous video. Then we have a look at price volatility over here, and we can see that price volatility can also go to extremes in terms of the relationship, and we can see the average price relationship. We can see today's the average price volatility, today's price volatility, and the number of standard deviations from the mean in price volatility. And we saw that mean reverting nature of beta and the mean reverting nature of basis in the previous videos, and in correlation as well. And now we've tied in the implied volatility. And we've looked at only one way of looking at IV, I might add. There's other ways that you could analyze the IV in pairs as well, and we've just looked at one in this video, which is to take a spread. So what we're looking for are times when one pair is trading at relatively high volatility to another as compared to, on a historical basis. So what we looked at when Tasty Trade put the video on 7/24/14 together called beta weighted pairs trading, what they were looking at was that the basis had blown out on the IWM. What we're looking at here is sort of how that works from four different directions all together. We have a QIWM that's 81% correlated. We have a basis which is at 1.9, which is well outside of the average basis in terms of standard deviations. So we're 2 standard deviations from the average here. We're very well correlated here. We have a beta that is a price volatility. This is to the SPY, but we could do it for the Qs, and you could see that the IWM is in a period where it's experiencing a lot of price volatility. Then we can come over and look at implied volatility, and we can see that the IWMs are in a period of very high implied volatility. But then we can compare that against the Qs, and we can say that the spread in the that the IV in the Qs is relatively low in that relationship as compared to the IWM. And so when we put that trade on, what are we looking at? We're looking at the mean reversion. We're looking at those IVs reverting. So when we go long the IWM, we're fading high volatility. And when we go short the QQQ, we're shorting the lower IV of the pair. And so it's all just another way of expressing the fading of high volatility. Only in this case, I really like the way this has come out, because you wouldn't simply look at the Russell and say, well, we're at a 44 IV rank, and so I'm going to buy it because I think it's going to go back. Instead, you're taking a short. So you're taking your betas down, you're taking your capital requirement down by having a short on the Qs because it's of less volatility, and a long in the IWMs, looking really for a mean reversion in the basis, mean reversion in the beta, and a mean reversion in implied volatility. So that is it for this series. If someone else would like to come in here and take a look at implied volatility in another way, or to pick up where I've left off, or to do anything else, I'd be really happy to watch it. But until then, I appreciate your time, and good luck.